Today, we're focusing on financing in corporate real estate. This involves how companies structure funding for strategic property decisions, utilizing various options like debt, equity, and hybrid capital. Understanding these financing methods is crucial because they directly impact a company's capital strategy and overall financial health. Over the next 26 slides, we'll dive deep into these concepts to give you a comprehensive overview of how corporate real estate financing works. Corporate real estate plays a strategic role in any organization, but financing it can be quite challenging. It often puts pressure on capital resources, limits financial flexibility, and increases risk exposure. While property supports day-to-day operations, it also represents a long-term commitment on the balance sheet that can't be overlooked. The funding decisions we make directly impact key financial areas like liquidity, leverage, and how our financial health is reported. The real challenge lies in securing the necessary space for our business needs without compromising the strength and stability of our core operations. Here, we're looking at the market scale and opportunity within U.S. owner-occupied corporate real estate. The estimated value locked in this asset class is over $3 trillion. That's a massive balance sheet asset, one that has potential to significantly impact how companies manage liquidity, leverage, and return on capital. For many businesses, their property isn't just space they need to operate. It represents one of the largest untapped sources of strategic financing. This means the opportunity here goes far beyond just funding real estate needs. It's about unlocking the capital embedded in these assets. Why does this matter? Because real estate can be leveraged in multiple ways. It can support additional debt capacity, enable sale leasebacks, facilitate joint ventures, and allow for portfolio optimization. Essentially, real estate becomes a powerful financial tool that companies can use to strengthen their balance sheets and fuel growth. When considering how to finance corporate real estate, companies often face the choice between owning and leasing. Let's look at the advantages of each approach. Owning real estate gives a company full control over the space and its timing, allowing for customized use. It also enables value capture, meaning the company benefits from any appreciation in the property's value. Additionally, ownership provides cost stability by locking in long-term occupancy costs, making it especially beneficial when the space is core to the business and needed for a long duration. On the other hand, leasing offers capital flexibility, which helps preserve cash for operations since it avoids a large upfront investment required to buy. Leasing also allows for faster scaling, making it easier to expand or exit as business needs change. Risk transfer is another key advantage of leasing, as it helps avoid exposure to residual value fluctuations in the property. This makes leasing particularly suitable when agility and flexibility are more important than the financial benefits of ownership. Ultimately, the choice depends on a company's strategic priorities, balancing the benefits of control and value capture with the need for flexibility and risk management. When we talk about real estate financing, it's important to understand how it impacts both sides of the balance sheet and then flows through the income statement and cash flow. On the asset side, land, buildings, and improvements are recorded as property, plant, and equipment. On the liability side, mortgages, leases, and covenants represent the debt, which increases the company's leverage. This financing has direct effects on the income statement, primarily through depreciation and interest expense, both of which reduce reported earnings. Then, when we look at cash flow, we see that debt service, rent payments, and capital expenditures influence both operating and financing cash flow. So, financing corporate real estate isn't just about acquiring assets. It involves a complex interaction between owned property, the capital structure, and how these elements affect financial statements. Some effects, like depreciation, are non-cash but still impact earnings, while others, like debt payments, have actual cash flow consequences. Understanding these dynamics is key to managing corporate real estate effectively. When we talk about traditional financing, mortgage loans play a central role in corporate real estate. These loans are secured by the property itself, which means the lender has a claim on the asset if there's a default. When lenders consider these loans, they underwrite not just the property, but also the strength of the sponsor and projected cash flows, ensuring the investment is sound. One of the advantages here is a predictable repayment structure. These loans typically come with fixed or floating interest rates and include amortization schedules, providing clear debt service obligations. This predictability helps both the borrower and lender manage cash flow and plan accordingly. Another key point is that mortgage debt usually comes at a lower cost compared to equity. Using debt allows the borrower to preserve ownership and control of the asset while avoiding the more expensive capital that equity financing demands. However, covenants are crucial in these loan agreements. Lenders often impose leverage limits, debt service coverage ratio requirements, and refinancing risk considerations. These covenants are designed to maintain flexibility and protect both parties over the hold period. Overall, mortgage loans represent the most common financing structure in corporate real estate. Senior debt backed by tangible assets, offering a balanced mix of security, cost efficiency, and predictability. So, let's break down how commercial mortgage-backed securities, or CMBS, actually work. It starts with the origination phase, where lenders make commercial mortgage loans to borrowers. These individual loans don't just stay separate, they are pooled together, combining many loans into a single portfolio. Next comes the structuring phase. Here, the cash flows from those loans are split into different bond tranches, which are essentially slices of bonds that carry varying levels of risk and return. Finally, these structured securities are distributed to investors who purchase them, providing the lenders with capital and transferring the mortgage risk to the broader capital markets. In essence, a single loan gets transformed into a marketable bond, moving risk off the lender's books and enabling financing for commercial real estate. It's a process that goes from loan origination to pooling, tranching, and then distribution, turning loans into bonds that can be bought and sold. Here, we're looking at an alternative financing strategy called a sale-leaseback. Basically, a company sells its property to an investor, but immediately leases it back to keep using it for its operations. This approach allows a company to convert that real estate, which is usually quite illiquid, into cash without disrupting business. The process has three main steps. First, the company sells the asset at market value, transferring ownership to an outside buyer. Second, the company leases the property back under a long-term agreement, so it can continue to occupy the space as usual. And third, with the capital now unlocked from the sale, the company can redeploy those funds into growth opportunities, pay down debt, or enhance liquidity strategically. The key benefit is that the business maintains its use of the property without the capital being tied up in ownership. This structure can improve balance sheet flexibility and provide cash that can be directed toward the core business, making a powerful tool in financing corporate real estate. Real estate investment trusts, or REITs, are a powerful tool for companies to tap into real estate capital. Essentially, REITs are vehicles that own, operate, or finance income-producing properties, making it easier for businesses to raise funds tied to real estate assets. One of the key advantages of REITs is public market access. Because ownership is tradable, companies have a scalable way to attract capital from a broad base of investors. Another important point is the income distribution feature. REITs place a strong emphasis on dividends, which makes them particularly appealing to investors who are focused on steady income streams. Tax efficiency is also a significant benefit. REITs often receive pass-through tax treatment, which can enhance after-tax returns for investors. Finally, asset monetization through REITs allows corporations to unlock hidden value in their real estate holdings, all while continuing to occupy and use these assets strategically. This makes financing corporate real estate more flexible and efficient overall. Here, we're looking at joint ventures and partnerships as a strategy for financing corporate real estate. At the core, shared capital means that a corporate occupier teams up with an investor or developer to fund projects like acquisition, development, or repositioning. This approach helps spread out the financial risk, reducing the exposure of any single party's balance sheet. In these partnerships, roles are clearly defined. One partner might bring in land, tenant relationships, or specialized operating expertise, while the other focuses on providing capital, managing execution, and overseeing the asset. This division plays to each partner's strengths for a more efficient collaboration. Economically, returns are structured to reflect this partnership dynamic. They use negotiated waterfalls, preferred yields, and promote structures, all designed to align incentives, so that both parties benefit from strong performance and timely execution. However, it's crucial to pay attention to governance, exit rights, leasing control, and decision-making thresholds. These factors are just as important as financial terms because partnerships often last over long holding periods, and clear agreements help prevent conflicts down the road. Overall, joint ventures and partnerships work best when balancing capital needs and control is essential, providing a flexible way to share resources and risks while pursuing corporate real estate goals. When it comes to financing, there are two main paths, debt and equity, and each comes with very different trade-offs. Starting with debt, the cost involves fixed interest payments, which represent the return lenders expect. One key characteristic of debt is priority repayment. It gets paid back before anything else, and importantly, it doesn't dilute ownership. However, it does come with downside risks, including covenants and exposure to default. Debt financing works best when cash flow is stable and maintaining control over the company is a top priority. On the other hand, equity financing carries a higher cost because investors target a higher return. The return to equity investors is tied to the residual upside, meaning they share in the profits after debts are settled. The biggest trade-off here is ownership dilution and share control, which means giving up some decision-making power. The good news is that equity doesn't require mandatory payments, which provides more flexibility. This path is often better when the business needs flexibility and has growth potential that can justify a higher cost of capital. So, when financing corporate real estate, choosing between debt and equity depends largely on your priorities, whether it's control and stability or flexibility and growth potential. Here we're looking at the cost of capital considerations and how different financing methods impact the weighted average cost of capital, or WACC. The key point is that mortgage-heavy structures typically minimize WACC while allowing the company to maintain control. In this slide, you can see several financing strategies compared side by side. For instance, mortgage loans combined with retained equity have a debt cost of 5.6%, equity cost 11.8%, and a target capital mix of 70% debt and 30% equity, resulting in a WACC of 6.8%, which is the lowest blended hurdle here. CMBS execution offers a slightly lower debt cost at 6.2%, with a bit higher equity cost at 12.1%, and a capital structure weighted 75% debt to 25% equity, leading to a WACC of 7.2%. Joint venture capital has a higher equity cost at 14.5% and a more balanced 50-50 mix, which pushes WACC up to 9.1%. REIT-style equity raises come with a higher equity cost at 13.6% and a mix skewed towards equity at 60%, resulting in a 10% WACC. Sale-leaseback structures don't have debt costs but have the highest WACC at 9.4%, mainly due to lease deductibility and a 100% equity component. The takeaway here is that cheaper debt lowers the overall WACC, but beyond a certain point, the benefits start to diminish as the company faces increased inflexibility and covenant risk. This slide assumes stable cash flow, an investment-grade tenant profile, and normalized rates to provide this comparison. Understanding these trade-offs helps guide the right financing strategy for corporate real estate investments. Now, let's focus on risk assessment and mitigation in financing corporate real estate. First, when dealing with interest rate risk, it's important to use fixed-rate debt where possible to provide predictability in payments. Additionally, incorporating hedges and staggering debt maturities can protect against sudden rate increases. Second, for market risk, stress testing values helps us understand potential downside scenarios. Diversifying our exposure across different markets or property types also reduces vulnerability, and underwriting conservatively ensures that we're not overestimating value or income potential. Finally, operational risk can be managed by strengthening lease terms to secure stable income, maintaining reserves to cover unexpected expenses, and implementing strong asset management controls to oversee property performance effectively. Together, these strategies form a comprehensive approach to managing the key risks involved in financing corporate real estate. Let's take a closer look at the interest rate environment and how it impacts financing in the corporate real estate sector. Higher interest rates tend to compress valuations, which means the overall value of assets may decrease. At the same time, rising rates make debt servicing more expensive, increasing the cost of borrowing. This tends to shift demand toward more flexible capital structures that can better adapt to changing rates. Base rates play a crucial role because they essentially shape every deal. Whether you're underwriting a new investment, planning refinancing, or deciding between fixed and floating rate debt, these decisions are all influenced by movements in the interest rate curve. You can see here the historical and projected trend of policy rates from 2019 through 2025. After several years of relatively low rates, we've entered a peak tightening cycle, with rates reaching around 5.6% more recently before projecting a slight decrease to roughly 4.5% moving forward. Understanding this trend helps in timing refinancing and structuring deals to minimize costs and risks. Overall, staying attuned to these shifts in interest rates is essential for effective financing strategies in corporate real estate. It dictates not only current valuations, but also the financial terms that will govern deals moving forward. Here we're looking at the three primary methods used in valuation and appraisal, all critical for determining the value of corporate real estate. First, the income approach values a property based on its expected cash flow, capitalization rates, and operating income. This method is particularly useful for income-generating properties because it directly links value to the property's ability to generate revenue. Next, the market approach benchmarks the property against comparable sales and current market pricing. Essentially, it looks at similar properties that have recently sold to estimate a fair market value, making it very practical in active real estate markets. Finally, the cost approach estimates value by adding the land value to the replacement cost of the building, then subtracting any physical or functional depreciation. This method is often used when the property is unique or new, where there may be limited comparable sales. While each approach uses a different lens, they all contribute to one value conclusion, helping finance professionals make informed decisions about corporate real estate investments. When it comes to financing corporate real estate, understanding tax implications and having a smart strategy can make a significant difference. One major advantage is how ownership can be structured to create cash flow benefits. For example, interest expense on loans can be deducted, but it's important to note that this deduction is currently capped at 30%. Another key aspect is depreciation. The building itself depreciates over a long period, typically 39 years, but by using cost segregation studies, certain components of property can be depreciated much faster, usually between 5 to 15 years. This accelerated depreciation helps reduce taxable income more quickly. Additionally, there are property tax and operating cost deductions that apply on an ongoing basis, which can further improve cash flow. On top of these deductions, state and local governments often provide incentives or credits to encourage investment, which can help lower overall tax liabilities. Finally, considering how to structure exits and timing of gains is crucial. By deferring capital gains through specific strategies, companies can manage tax burdens more efficiently when selling or transferring property. All these elements combined create opportunities to optimize cash flow through smart tax planning in corporate real estate financing. When it comes to financing corporate real estate, execution discipline is absolutely critical. Before committing any capital, we need to thoroughly pressure test the asset, from the projected cash flows to the legal structure behind the deal. This process helps us uncover any hidden risks early on, which is essential for protecting the valuation, securing favorable financing terms, and ensuring that the closing goes smoothly. Our due diligence checklist is a structured approach to this. First, we start with a title and legal review to confirm ownership. Check for easements, zoning compliance, encumbrances, and any litigation that could impact the transfer or financing of the property. Then, we conduct a comprehensive environmental assessment, usually beginning with a Phase 1 study, and moving to Phase 2 if necessary, to identify any contamination or regulatory liabilities that could pose problems. Next, we validate the financials by underwriting the historical net operating income, rent rolls, operating expenses, capital expenditure needs, and potential downside scenarios, comparing all of these to lender assumptions for accuracy and completeness. Physically, we inspect the property's structural and mechanical systems, including the roof, building envelope, mechanical, electrical, and plumbing systems, life safety components, deferred maintenance, and upcoming capital replacements. We also perform a lease and occupancy analysis, reviewing tenant creditworthiness, lease rollover schedules, termination rights, concessions, and risks related to tenant concentration, all of which impact the durability of cash flows. From a financial structuring perspective, we assess property tax exposure, transfer taxes, depreciation profiles, and whether the current holding structure optimizes financing efficiency. Finally, we verify insurance coverage adequacy and check for compliance with regulations like the ADA, fire codes, and other legal requirements that could affect either the closing or future operations. By following this disciplined review process, we safeguard the investment and position ourselves for a successful transaction. On this slide, we're looking at emerging financing models that are transforming corporate real estate. Traditional bank lending is no longer the only way to secure capital. New capital channels are expanding access, speeding up processes, and creating better alignment between investors and borrowers. There are three key models reshaping this space. First, crowdfunding platforms. These digital marketplaces allow smaller investors to pool their resources, making property financing that used to be exclusive to large institutions more accessible. The main advantage here is broader access to capital and faster syndication, meaning deals can close more quickly. Second, blockchain-backed loans. By using tokenized ownership and smart contracts, these loans improve how collateral is tracked, serviced, and settled. This results in greater transparency and less friction throughout the loan lifecycle, benefiting both lenders and borrowers. Third, sustainability-linked loans. These loans tie borrowing costs to specific ESG or energy performance targets. If the borrower meets these measurable goals, they can enjoy lower financing costs. This model encourages strategic alignment with sustainability objectives, which is increasingly important in today's market. Together, these emerging models are changing how corporate real estate is financed, offering more innovative, flexible, and mission-aligned options. When we talk about ESG-focused financing, we're referring to financial structures that link the terms of capital to how well a property performs in terms of efficiency, responsibility, and transparency. In the context of corporate real estate, this translates into green loans, sustainability-linked debt, and a growing investor preference for buildings that have lower carbon footprints and are more resilient. The key takeaway here is that better performing assets, those that meet strong ESG criteria, can access cheaper capital and attract a wider range of investors. The priority metrics guiding these financing decisions typically focus on energy consumption, carbon emissions, and the building's resilience. Essentially, integrating ESG principles into real estate finance not only supports sustainability goals, but also enhances financial viability and investor appeal. Here, we're looking at the capital stack, which is essentially the hierarchy of financing sources in corporate real estate. Starting from the bottom, we have senior debt. This carries the lowest risk and offers the lowest return, typically between 4 to 7% interest, because lenders holding senior debt have the first claim on the property's cash flow and assets. Moving up, mezzanine debt sits above senior debt. It's a bit riskier and offers higher returns, generally between 8 to 12% interest, but it still holds a junior claim compared to senior debt. Next is preferred equity, which commands higher risk and higher expected returns, usually between 10 to 14%. Preferred equity holders have priority over common equity in payment, but are subordinate to all debt holders. At the top is common equity. This involves the highest risk because common equity holders are last to be paid. However, it also offers a potential for the highest returns, often exceeding 15%. This structure clearly shows how as claims move up the stack, both risk and expected returns increase, with senior debt being the safest and common equity being the most speculative. Understanding this hierarchy is crucial when financing corporate real estate investments. Here we have a case study illustrating a successful corporate real estate transaction. The deal involved acquiring the Austin headquarters campus, a class of corporate campus spanning 620,000 square feet, for a purchase price of $185 million. The financing structure was carefully designed with 60% debt and 40% equity, utilizing a senior mortgage alongside strategic joint venture capital. This blend allowed for an efficient capital deployment while managing risk. Investor returns were strong, with a levered internal rate of return of 14.8%. These returns were stabilized by the leaseback arrangement and the operating savings achieved through the deal. The key outcome was unlocking liquidity, without compromising occupancy, ensuring that the company retained its operational presence while optimizing the capital structure. This case exemplifies how thoughtful financing strategies can drive value in corporate real estate. Refinancing works best when the timing aligns across three key factors: the direction of interest rates, the loan's maturity, and the performance of the underlying asset. The optimal window to refinance is before you experience any maturity pressures, not after. First, watch the market for the right moment. Start your underwriting process when interest rates have peaked or when credit spreads begin to tighten. This typically happens after central banks shift from raising rates to pausing. At this stage, property net operating income remains stable or is improving, and prepayment costs are still manageable. Second, move early. It's critical to refinance 6 to 12 months before your loan matures. This gives you better negotiating leverage. When debt service coverage is comfortably above your covenant levels, the appraised property value supports stronger loan terms, and lenders are actively competing for quality assets. You know you're in a favorable position. Finally, lock in your advantage. Extend the loan duration when lower rates and stronger fundamentals create a clear spread benefit. Fix your rates if the cycle looks like it's nearing its lowest point, and if rate cuts are still expected, consider using floating rate debt. Additionally, if your property's value has increased, combining refinancing with recapitalization can leverage that growth. By carefully monitoring these phases and acting strategically, you can maximize the benefits of refinancing and strengthen your financial position. Today, we're seeing a significant shift driven by technology and digital platforms in real estate finance. This fintech shift is transforming how capital flows by making it faster, smarter, and more transparent. Digital lending platforms, data rooms, and AI-powered underwriting tools are revolutionizing the process by shortening deal cycles. They also broaden access to lenders, increase pricing transparency, and speed up execution for corporate real estate teams. These platforms centralize due diligence, allowing teams to benchmark terms more effectively while connecting borrowers to capital more efficiently. Essentially, it's all about having one integrated platform that supports the entire financing process, from sourcing opportunities to underwriting deals, all the way through closing. This streamlined approach is reshaping how we finance corporate real estate, making it more agile and responsive to market needs. Navigating regulatory and compliance requirements is essential in corporate real estate finance because it intersects with multiple legal and financial frameworks. First, public companies are subject to SEC disclosure rules, which require them to fully and accurately report material leases, impairments, sale-leaseback transactions, and financing obligations. Failure to do so can lead to risk from investors, auditors, and regulators. Next, banking and credit regulations play a critical role. Lenders enforce standards like leverage limits, collateral requirements, and anti-money laundering rules. For borrowers, this means maintaining thorough documentation to support underwriting and ongoing compliance. State real estate and UCC laws also come into play, as property transfer, title, foreclosure, and security interest regulations vary from state to state. Any transaction must comply with the specific legal framework of the jurisdiction where the asset is located. Tax and accounting standards have a direct impact on financing outcomes. Proper lease classification, depreciation methods, interest deductibility, and gain recognition align with rules like ASC 842 and applicable tax codes. So aligning these terms early in the process is critical. Finally, environmental and zoning compliance cannot be overlooked. Issues related to permitting, land use, environmental liabilities, and building codes can delay funding or diminish property value. Due diligence ensures a property is both financeable and operable according to plan. Together, these key frameworks form a foundation for successfully financing corporate real estate while managing risk and regulatory obligations effectively. When it comes to financing corporate real estate, it's crucial that your capital strategy and real estate strategy are aligned and work hand in hand. This alignment ensures your financing decisions support your overall business objectives effectively. Next, it's important to match the financial structure to the specific asset, your business goals, and how long you plan to hold the property. Different scenarios call for different approaches, so a one-size-fits-all solution rarely works. Using debt can help lower your cost of capital, but also increases fixed obligations and your exposure to refinancing risks. On the other hand, equity financing offers greater flexibility, which is especially valuable if your balance sheet capacity is limited or if you want to reduce risk exposure. Timing plays a critical role because interest rates, property valuations, and the state of credit markets directly influence the outcome of your financing decisions. Making moves at the right time can make a significant difference. Additionally, tax implications, accounting standards, and ESG considerations can materially affect which financing option is best for your company. It's important to factor these elements into your decision-making process. Finally, strong due diligence and risk controls are essential to protecting the value of your investment both before and after the deal closes. These practices help ensure that your financing supports long-term success. To move forward effectively, it's important to focus on the next steps and available resources. Engaging consulting firms can provide valuable expertise in capital strategy, structuring, and execution support, helping to tailor solutions to your specific needs. Industry associations also play a key role by offering market benchmarks, hosting events, and facilitating peer insights, which keep you connected to the latest trends and best practices. For deeper understanding, consider further reading on crucial topics such as debt markets, lease strategy, valuation, and tax implications. As a recommended approach, start by building your short list of advisors, gather relevant benchmark data, and prepare a detailed financing memo. This structured process will ensure you move confidently from research into execution, setting a strong foundation for financing your corporate real estate initiatives.